Being Smart About Student Loans by Texas A&M University of Kingsville, Title V I Care Grant. This presentation is meant to help federal student loan borrowers get into the important habit of tracking their loans. By developing good borrowing habits, you'll take out only what you need to attend college and can afford to repay when you complete your program of study. This material is not intended to constitute any tax, investment, or legal advice. If you need investment, legal, tax advice, and/or credit counseling, please consult with a professional within those areas. If you're comfortable sharing, how many of you borrowed a student loan? If you have, how do you feel about that? Statistics tell us that if you haven't yet borrowed a student loan, it's likely that you will before you graduate. But here's the good news. Student loans are generally considered good debt in that you will see a return on your investment. If you need a student loan to achieve your degree, there is a payoff. College graduates earn, on average, 66% more through their lifetimes compared to high school graduates. So even if you haven't yet borrowed a student loan, we hope you'll find some useful information in our session today about how to be wise and proactive in your future borrowing decisions. If you have already borrowed a student loan, you may remember that you went through something called entrance counseling to make sure you had a good understanding of the rights and responsibilities associated with your loan. But you may not remember much of what you learned. With a lot of information coming at you fast, new school, new roommate, new schedule, new everything, you were dealing with some drastic changes in your life. Maybe someone said, "Read this and then sign," but now you don't really remember what you signed. In this presentation, we will provide you with a refresher about 1. Understanding the differences between private education and federal student loans. 2. Monitoring your debt level. 3. Knowing the impact of your debt level on your credit history. And 4. Thinking about how much you can afford to borrow. Let's get started. Different loan types. First of all, let's talk about the different kinds of student loans. At a very high level, there are two kinds, federal and private, and you may have a combination of these. Federal student loans are from the U.S. Department of Education. These include direct unsubsidized and subsidized loans, Perkin loans, and PLUS loans. To get a federal student loan, you can visit our financial aid office located at the Student Union building. You also are required to complete a free application for Federal Student Aid, or FAFSA, before applying for the loan. Federal student loans often have a low interest rate compared to private student loans. Another important thing to keep in mind about federal student loans is that the conditions and benefits, like repayment plans, forgiveness, and interest rates, are regulated by the U.S. Department of Education and are the same for every borrower. The place to start in tracking your federal student loans is the National Student Loan Data System, NSLDS. This is the U.S. Department of Education's central database for student aid. Your school, the Federal Direct Loan Program, and the U.S. Department of Education submit information about your federal student loans to this database. You can directly go to the NSLDS website, but you can also get there by going to studentloans.gov, which may be an easier URL to remember. You'll use your FSA ID to log into the system, which is the same logon information you use to complete the FAFSA. Here, you will find information about the federal student loans you have borrowed, as well as your Pell Grant history. You can find out how much you've borrowed, your interest rate, and who your loan servicer is. Your loan servicer is a company the Department of Education has directed to administer your loan, which means they will be your point of contact for everyday questions or concerns about your loan, in terms of billing, choosing a repayment option, and asking for assistance if you're having trouble repaying your loan. If it's available as an option, it might be a good idea to create a login account now to monitor your loan balance and, once you've left school, to verify your progress in paying down your loan balance. Private education loans are different in that they come directly from lending institutions such as banks and credit unions. The interest rate for a private student loan will depend on a variety of factors, including your credit history. If you don't have much history with credit and repayment, you will likely need a cosigner for a private education loan. That is, someone who will sign the application with you and promise to pay the loan back if you do not or cannot. You don't have to complete the FAFSA in order to get a private loan, but you will need your school's financial aid office to approve it. Also keep in mind that private education loan conditions and benefits vary, including repayment options, depending on the lender that makes the loan and the creditworthiness of the borrower. The best source of the information for tracking and verifying private education loans will be the lending institution from which you borrowed the money. If you don't remember from which bank or credit union you borrowed the loan, you should have a copy of the promissory note you signed, or possibly email correspondence about the loan. Most lenders have an online system for tracking your loan, so when you take out a private education loan, make sure that you ask the loan servicer about accessing your loan details online. That way, you can check your loan status and keep track of your loan history. If you don't have or can't find a copy of your promissory note for these loans, your college's student portal or financial aid office may have the information to point you in the right direction to get started. Finally, your credit report will help you verify details on any private education loans. Your loan will be listed on your credit report, including the name and contact information for the lender and the loan amount. We'll talk more about credit reports in a moment. Keeping track of debt. If you don't track your student loans, there can be negative consequences, such as not knowing who to contact when you need help, difficulty obtaining access to online information because you don't know the details of your loans, missed payments, loan default, and an adverse credit history. This is important because it's possible that you could be paying a student loan bill every month, only to find out that you've been missing, all along, another payment you owed but hadn't carefully tracked on a different type of student loan. This situation, one in which you are in default on a student loan you haven't carefully tracked, is one you want to avoid. Do you know at what point a federal student loan goes into default? The answer is if you don't make a payment for 270 days. Your student loans are an important part of your financial life, and the most important takeaway from today's session is that these loans are your responsibility to track. Don't rely on your school to keep track of this information for you. Because there are different types of student loans with different rules and policies, there is some complexity to manage, but it is doable, and there are resources available to help you find and manage your loans. Student loans and credit. In this section, we'll talk about what a credit report is, what it tells us about our financial wellness, and how you can get a copy of yours. How do my student loans affect my credit? And what does it mean to have bad credit? Like bad grades, a bad credit history can greatly impact your quality of life. If you have a history of not repaying your debts on time and as agreed, lenders may be reluctant to give you credit in the future. You may also pay a higher interest rate because lenders see you as a risky borrower. It's not just your future credit that's harmed though. You could also have difficulty renting an apartment, getting a job, or qualifying for insurance if you have bad credit. This is because if you have a history of not paying your debts, employers and landlords may think you'll also be a risky employee or renter. Your student loans are an opportunity to build good credit. You can get a copy of a credit report for free from each of the 3 credit reporting agencies once a year. The official site for this is www.annualcreditreport.com. You can ask for all 3 at once. This may be a good idea if you've never looked at your credit reports before, so that you can compare all 3 to make sure the information is consistent. After that, you can rotate through the reports. Request one every 4 months, so that you can monitor your credit throughout the year. You may have heard of something called a credit score. This is based on your credit report, but is separate from it. Credit scores are determined by private companies. Fair Isaac Company Incorporated, or FICO, is the largest and most well-known. These companies use formulas to predict how likely you are to repay a debt, also known as your credit worthiness, and assign a number or credit score to you. When a lender requests your credit report, they will also receive your credit score. While getting copies of your credit report is free, you'll likely pay a fee to get your credit score, although many major credit cards now offer free credit score monitoring. The FICO credit score is the most used credit score, the median, not the average. FICO score is 720 out of a possible 850. Remember, median means that half of the scores are above 720 and half are below 720. The riskiest customers have scores below 600, while higher scores are better and will result in lower interest rates. A lower credit score will result in paying higher interest rates on your debt. A positive credit history begins by taking control of your spending habits and thinking carefully about spending on your needs and wants. Your payment history is a crucial element in building good credit, and it doesn't just matter that you pay. You should pay on time. Your payment history is the most important factor in your credit score, making up 35% of it. The importance of paying on time is not just true of student loans either. For car payments, credit card bills, and any other payments, paying on time will build your credit history, allowing you to make larger future purchases on credit. That way, when you get ready to buy a home or car, you'll be able to qualify for a loan to do so. What if you just can't pay a bill? Not making payments is the worst option. Contact your creditors and ask how they can help. Your creditors are interested in making sure you can repay your debts and will generally work with you to ensure your successful repayment. They may be able to reduce your payment, extend your payment due date, or reduce your interest rate if you are having difficulty repaying your debt. Take a look around at what help you may find on your campus or in your community. You may qualify for free or low-cost medical care, access to a food bank, or vouchers to help with housing or childcare. While these won't pay your bills, they can help free up your income to use in repaying your debts. Bringing it back to federal student loans, pay close attention to the repayment options that are discussed during the exit counseling session you will attend before leaving college. There are lots of flexible repayment options to help you manage your monthly payments. How much to borrow? When you think about borrowing student loans each year, there are a couple of important pieces of information that can help you make a solid, informed decision about how much to borrow. First, think about how much you might earn when you graduate. Your income will vary depending on a number of factors, primarily your major and level of experience, as well as your location. Keep in mind that some majors have lower starting salaries than others. For instance, the starting salary for a teacher will be much less than that of an engineer. Then, think about how much you've already borrowed and how much you may continue to borrow until you graduate. Using a loan repayment calculator, find out how much your monthly payment will be after you graduate, and explore payment amounts based on different repayment options. Now that you have those two pieces of information, think about how they fit together. Will you be able to afford your monthly student loan payment on top of your housing costs, possible car payment and insurance, and credit card payments based on your expected income as someone who is just entering your field of employment? If your situation seems a little unsure, find someone to talk to in your financial aid office or career services about potential steps you can take now to prevent difficulties later. Some good rules to follow in keeping your spending on track. Saving to buy something you really want. Let's say it's the latest gaming system. Costs less than buying it with borrowed money. In some cases, it might cost a lot less. That's because when you save money, you earn interest, and when you borrow money, you pay interest. Use a 2-day waiting period for any unplanned expense instead of putting it on your credit card right away. Waiting to spend might also give you time to figure out how much you really want that item and possibly avoid impulse buying. Bad debt is debt that costs us money. For example, paying for groceries or other consumables with a credit card. You'll pay a steep fee in terms of interest for something that loses value very quickly. But good debt, such as mortgage or a student loan, actually increases your wealth because you generally see a return on your investment through either rising home values or better career options. So borrow wisely if you need to, and think of student loans as an investment in yourself and your future. Check out these resources for more information.